2022. Retail apocalypse. Gold and silver bottoms. Inflation is hurting retail sales for the past couple of months. Inflation has been hurting the economy. Interest rates appear to have topped out. The cost of money is starting to price the stock market as going into undervalued territory. The situation is taken bullishly by the metals, with gold and silver moving up. Good morning, everybody. This is Patrick MontesDeOca with the live trading talk, live trading room here at the Equity Management Academy. I wanted to share this report that we just published a few minutes ago in the Associated Press and Seeking Alpha. Inflation is hurting retail sales. For the past couple of months, inflation has been hurting the economy, facing Facebook, Amazon, Apple, Walmart, Target, and a slew of others have all falling in stock value. Headlines are talking about a retail apocalypse as inflation is hammering the retail business. Interest rates have risen so fast that it is beginning to hurt the economy. The sentiment of the market as a result is very bearish. Talk of recession is growing. Many are saying that we may already be in a recession. The 10-year note is at 2.736, down 12.3 basis points. The 10-year note measures the interest rate environment we are in for the short term. Interest rates appear to have topped out. The market is telling us that the rates have made almost a head and shoulder top, with a peak at about 316 or 314. We are now at 276, so stocks and the mini S&P are therefore very undervalued. The cost of money is starting to price the stock market as going into undervalued territory. The situation is taken bullishly by the metals, with gold and silver moving up. This indicates that the cost of money and interest rates are going to decline. If we break below 275, then we are looking at the mid 2.5 rate on the 10-year note, which would take the pressure off the Fed to do anything else. The market has already discounted 2.5-point increase in the next two meetings, as it appears unlikely that the Fed will deviate from that plan. The cost of money is affecting the US dollar, which has regained a lot of the strength recently as rates have risen since March. The chart for the 10-year note is almost straight out the past few months. Rates affect every sector of the economy that uses debt, especially those who are over-leveraged and in debt. The note rose from about 0.33 in 2020 to the recent highs. If we break the 320 area on the 10-year note, it would confirm that the recession is underway. We are seeing pure margin call liquidation today by those affected by the rise in interest rates. Precious metals. Gold and silver appear to be putting in a major floor as the economic situation appears to be getting grimmer. Gold is at 1867, up about 19. Silver is at 22.20, up about 48 cents. Nugget is at 145, is up 145 at 50.06. Precious metals are gaining momentum as gold traders close, as gold trades close to 1900. Gold appears to be headed for about 1874, which is the variable changing price momentum indicator, VCPMI, standard deviation daily target for May 24, 2022. Silver has a target of 22.29 for today. Robo-Advisor Gold Weekly Standard Deviation Report. Nikki the Robot, our artificial intelligence AI advisor for the weekly gold report, says that the weekly trend momentum of 1909 is bearish. The weekly VCPMI of 1826 indicates a bullish price momentum. A close below 1826 stop would negate the bullishness to neutral. If short, take profits at 1804 to 1763. If long, take profits at 1867 to 1889. The levels the AI forecasts can serve as a GPS for your trading, using standard deviation and mean reversion. A contrarian signal, the VCPMI often goes against what the media sentiment and many analysts are recommending. Robo-Advisor Silver Weekly Standard Deviation Report. For silver, Nikki the Robot said in the weekly report that the weekly trend momentum of 2373 is bearish. The weekly VCPMI of 2156 indicates a bullish price momentum, or standard deviation. A close below 2156 stop would negate the price momentum to neutral. If short, take profits at 2104 and 2033 and go long. If long, take profits at 2229 to 2281. Mean reversion and standard deviation. The AI gave us the weekly trend momentum, which was bearish. That is the bigger trend. The weekly VCPMI of 2156 is, and it is a bullish price momentum and standard deviation, which means that the market is bullish within the bigger bearish trend. The VCPMI tells you when the bullishness would be neutralized, as well as when to exit your trades. The market today came close to the 22.29 level, when long should have taken some profits off the table. At that level, sellers start coming into the market and supply comes into the market, which causes the market to start coming back down again. Strategy. We have a long-term core position in gold and silver, which we are adding to on short-term corrections. In the long term, we believe that the VCPMI and standard deviation predicts that precious metals will move much higher. Disclosure. We have a beneficial long position in the shares of GDX, either through stock ownership options or other derivatives. Good morning, everybody. Patrick here, back into the live trading room here. Let's focus here on the NASDAQ that is following through for the fourth day. And we're up to 12,128.25, up about 187 points or 1.57%. And we seem to be breaking out of the daily sell to level targets of 12,110, and we pretty much have activated the weekly target of 12,458. The market is trading above the weekly standard deviation of 1974, It's a 50-50 standard deviation. And when the market trades above there, it activates the target above, in this case the weekly target of 12,458. In taking a look at the other assets here, gold is up 180 at 1870.30, and what we have seen here is basically a little bit of a correction since the 2020 level here, or 2000 level, was made back in around the middle of April, around the 18th of April. And what we have seen here is the market come down to this what appears to be an extreme level. Below standard deviation. On May 16, the low was made at about 1785, and this came into this area in blue, which according to the VCPMI, it identifies where the accumulation of supply or inventory is at the highest probability. And we're looking at, on a weekly basis, the market coming down to 1785 on May 16 into an area that offered a very high probability that the market can experience strong buy-in here that would take over the supply that you've seen here since the 2000 level. On the other side of the blue level, what you see here is red levels in sell prices. The daily average is 1859, and on the 24th the market got up to 1869, which completed the weekly sell one target that you see in red. So we are beginning to see prices getting into what it's called an area of resistance. And what the market needs to do here is it needs to break through this resistance, meaning the buyers are stronger than the supply that's being offered, and we can continue to see green bars unfold, penetrating this area, closing above 1889, and that would be essentially a daily and a weekly breakout, and it would project the levels of 1968 to 2017, which would be challenging the old highs. So we need to see this supply appear be taken out by strong buying. Now, in terms of silver, it seems that the silver market already has seen some good buying at the extreme below the standard deviation weekly, as you can see here, of 2104. When the price came down on this bar here, making a low of 2042 on May 13th, not too long ago, we saw a reversion unfold, which is what we expected, as this model here weekly is about 90% mathematical probability that if we see buyers come in here, and it tells us to expect, as I said, buying in this area, and we see this green bar come in here, that means that this has taken out this bid here, or these buyers here have taken out all the supply on the previous two bars, and then it keeps taking out all the supply that was offered up here. All the sellers up here begin to short cover, and we're now up against or trading above the daily average. We activated a daily buy trigger within a weekly bullish price momentum. So it's pretty good indication that we're going to be possibly challenging the highs here of about 22.37 on the daily, and the weekly has activated the levels of 22.40 to 22.81 for the silver market. And the silver market seems to be leading the way on this move up here. As a consequence, Bitcoin has made a low of 25,380 of this correction. As a consequence of this correction, it affected pretty much all the assets across the board, including stocks, the NASDAQ, metals, digital assets. It was a massive liquidation that took place, particularly in digital assets, as a consequence of all the highly leveraged traders that were in the market, has been in the market since pretty much the pandemic took place, and the Feds came in aggressively, pretty much supplying what the balance sheets on the Feds show an increase of just about $5 trillion just in the last couple of years. And we're looking at the Fed's balance sheet close to $9 trillion, which is a record amount of assets that the Feds own. And the task or challenge for them now is to get rid of those assets in order to reduce basically the amount of the money supply that's in the market here, which is basically the problem that we have right now, that there is a lot of money in the system. And it doesn't bode well, pretty much, when you have a possibility that interest rates are going to move up sharply. They already have moved up. This is my point. This is why I wrote the article here, that if you look back at interest rates, the market is leading the way to the Feds doing anything except until recently begin to act on it. They are behind the curve. And if we take a look at the 10-year note, the 10-year note is trading at 275. It's in that range now that 274 it's trading at, and that is the range basically that begins to price in the possibility that the markets, the stock markets, have gone down a little deeper based on just interest rates and the cost of money, which is what it's affecting everything here with regard to leveraging, over leveraging, or financing anything. So we saw here, just on the idea that interest rates are going up, and they've gone up, I would say not as much as the market, and this is where the Feds are lagging, because what you can see here is the rates on the 10-year note got up to about 3.25%. And, the Fed funds rate are still pretty much at a discount here. And what the 10-year note is indicating is that the fear of rising interest rates might have been overdone. And as a consequence, obviously, we've seen this massive correction here in equities and particularly the NASDAQ, which has suffered the most here, about down close to around 30%. And it's all been based upon recalibrating the cost of money, interest rates, And so I think what we're looking at now is pretty much at what's happened here with regards to the sentiment of the market as it relates to interest rates. And I think the sentiment of the market has brought the market to an extreme below standard deviation, and we should begin to see massive short coverings here as we move into the weekend, particularly holiday weekend here. I don't believe that you want to be short any of this stuff. And as this information begins to filter into Main Street, people are going to begin to realize that we might have topped out on interest rates, and it's a question of how that is going to affect inflation. What seems to be happening here is that the inflation is moving from one sector to another. We've seen a tremendous amount of inflation in construction, home supplies, everything related to real estate or building. And what seems to indicate some of the early numbers that are coming out with regards to consumer spending is that people are spending money in other items, personal items. It looks like the purchases of big items might have been put on hold here for a while, but recreational, expenditures or trips, clothing, something that will make you feel good after this last 2 years that has been just unbelievable. And so the demand is shifting, into certain areas. But the reality is that one of the major components of inflation, which is food and energy, are continuing to create the possibility that we may even see higher prices down the road. This conflict in Ukraine, between Ukraine and Russia, continues to destroy the available supply, particularly to the Eurozone and to much poorer nations like Africa, for example, which depend upon a great deal of the production from that area. And so all the ports have been closed, and there's a lot of politics going on back and forth discussing, certain, you might say, trades that could happen if Russia allows for some of the grain to be exported out of the region. What they want is the NATO nations basically to lift, and the United States to lift the sanctions. So it's a form of blackmail, political blackmail, pretty much. And it's a question of, how long we're going to be in short supplies. And so food shortage, food crisis is something that is going to build more over the next couple of months. And I believe that is what we may be beginning to see with regards to metals, with regards to inflation assets here, and I think that we could see once again the market resume the uptrend, particularly adjusting to the fact that I think the sentiment might have brought this market down beyond standard deviation, which kind of makes it interesting for traders like myself and other people that are self-directed traders to take advantage of the market. Let me come back here and take a look at the market where we are, but we are beginning to see a lot of buying interest taking place in the metals. Continue to be long in the metals here. Continue to hold on to your core position. Silver seems to be leading the way on this move up here, and we have the target of 22.18 in place. Again, the 22.29 is the weekly target that we've had for this whole week, and let's see what prices do here as they continue to show us a lot of resilience, and possibly anticipating that interest rates might not go up as much as the talk has been of raising a half a point or even up to 3/4 of a point into the fall of this year. In fact, what I believe is happening here, that there is a great deal of disparity in terms of, again, the pockets of inflation that we have, and there's no clarity yet to a certain degree how the consumer staples, retail businesses, Walmart, the Facebooks of the world, how are they going to react to current valuations that seem to be, again, at an extreme level beyond standard deviation. And so I think if we take a look at the NASDAQ, we've been recommending that the 11,500 was an incredible level, and again, putting interest rates at rest, or at least the sentiment at rest, that interest rates may not go any further higher or as high, or even, depending upon the economy, may revert down again, which is what happened in 2019. And if we were to see a change of course of the Feds from this talk of aggressive monetary policy, this hawkish talk, we may see some surprises here as we come into the summertime. September, August, we could be into new high territory. And that's across the board. Stocks, metals, digital assets. Continue to be patient, my friends. I think we're looking at a major bottom taking place. And I think, once again, it is my opinion that as we move into the end of this weekend, which is a holiday weekend, I would think that if I was short, I would be very nervous. We'll talk to you next time. Have a great trading day.